Understanding hedging. Hedge positions, while they do not require a margin like regular positions, can still be subject to closure due to market conditions, especially during times of high volatility, news releases, or when spreads widen. To provide you with crucial information when it comes to taking the opposition side of trades under the assumption it's a hedge, opening trades in the opposite does not mean you have netted off your risk as you thought, and if anything, you had increased it as all the trades had different entry prices. As we deal with clients on an execution-only basis and do not provide any advice, therefore, clients are solely responsible for managing their trade exposure and leverage. I would like to direct your attention to some external sources attached which support this explanation, as provided in my previous email. These sources elaborate on the potential challenges faced when maintaining fully hedged positions, such as the risk of spreads widening and potential overnight financial charges. This stop-out trigger to close hedge positions is based on market dynamics and risk management principles. Hedged buy and sell gold trades on 500. Leverage can expose traders to the risk of an equity stop due to the widening of spreads. Here's how this risk works. Understanding hedging. Hedging in trading refers to opening two opposing positions simultaneously to reduce risk. In the case of buy and sell gold trades, a trader might go long one lot of gold while simultaneously going short another lot of gold. This strategy aims to offset potential losses in one position with gains in the other. Leverage. Leverage allows traders to control a larger position size with a relatively smaller amount of capital. In this scenario, with 500 leverage, traders can control a position size 500 times larger than their actual account balance. While leverage can amplify profits, it also amplifies losses. Widening of spreads. Spreads refer to the difference between the bid, selling, and ask, buying prices of an asset. In volatile markets or during certain trading hours, spreads can widen significantly. This means that the difference between the buying and selling prices becomes larger. Now, let's consider how the risk of an equity stop due to spread widening comes into play. When you open a hedge position, you have a long buy position and a short sell position simultaneously. These positions ideally balance each other out. However, if spreads widen significantly, it can lead to an imbalance. For example, the spread on the short sell position may widen more than on the long buy position. As a result, the loss on the short position can exceed the gain on the long position, leading to a net loss. When 500 leverage, even a relatively small movement in the wrong direction can result in a substantial loss relative to your account balance. If the loss on one side of the hedge becomes too large and approaches your account balance, it can trigger an equity stop. An equity stop is a risk management mechanism that brokers use to protect traders from losing more money than they have in their accounts. When your account equity falls below a certain level due to losses, the broker may automatically close out your positions to limit further losses. In summary, while hedging can be a risk management strategy, traders using high leverage need to be cautious of spread widening. If spreads widen significantly and create an imbalance between the hedge positions, it can lead to a situation where the equity in the account falls to a level where an equity stop is triggered, closing out the trades to limit losses. To manage this risk, traders should monitor spreads, use appropriate position sizes, and consider the potential impact of spread widening when employing hedging strategies, especially with high leverage.